What's going on, man? Back for another one.
Yes, we are.
How was your week?
My week was pretty good, actually.
Yeah?
We've
Anything exciting happen?
well, we looked at a potential spot to move our pool room to.
Yeah, I'm really hoping you pick that one in Midtown. That would be pretty cool.
Well, bad news on that one.
Oh, no.
He says the bank wants to sell it for $1.6 million, and I said that's a little out of our budget. So I think that one's off the table.
Unfortunate.
Yeah.
Unfortunate. We had a kind of interesting week here. I did a refund or an amendment for a client and secured them a pretty large refund of about $40,000-ish. And the IRS sent a check for $890,000.
Excuse me?
The IRS made a huge mistake on one of my clients. They sent a check for way more money than we requested. And it's our fault that we did it, apparently. We didn't do anything wrong, but they said that we had submitted some form incorrectly, which we didn't. And that's why it was a mistake, when really it was just a mistake in their system. And I don't know who in their right mind approved a check. Somebody has to approve that to go out. They're just like, oh, okay, $890,000, there you go.
With no supporting history or anything like that.
The client didn't even make that much
money.
Right,
that's what I was thinking.
It's ridiculous. It's ridiculous. So we had to schedule an appointment at the IRS office to take the check back, to hand it to them, showing that we voided it and didn't cash it. Because if we cashed it, they start charging us interest on it.
How much is the interest rate? It might have been a cheap loan.
It's 3%, but the thing is they'll also give you a penalty. So we figured that we couldn't make it up in the money market, unfortunately.
Yeah.
Yeah. It would have been a good one, though. Well, that was the big mistake of this week. I'm Scott Hess, tax and business consultant.
I'm John Barton, small business owner. Remember the tortoise and the hare? Slow and steady wins the race.
We started Turtlesmith to help people start small businesses, providing information and resources to small business owners and entrepreneurs.
Build a solid foundation and forge your dreams.
So I think we're just going to start with our step 4 of phase 3, which is financial analysis. So this one's a bit dry and unfortunately a little boring, but it's a very important step. As you're going through building your business and getting your first sales, you need to be continuously analyzing your financial statements.
See, I think that a lot of new business owners, they really get caught up in how much they're bringing in, their revenue. And whenever they talk to people about, how good their business is doing, it's always about how much revenue it's bringing in.
Yeah, that's very common.
And it can be intoxicating. It really can be. You can be bringing in a lot of money, but not actually making a lot of money. And that's the key point here, where the financial analysis gives you those insights and shows you what numbers to really be focused on.
Yeah. Mark Cuban actually told a funny story of one of the Shark Tank companies he invested in. They had like a huge boost in sales, but then their cash kept going down, and they couldn't figure out what was going on. So they had a sale where they gave the product for like $45, and it cost them $25 to make it. So they were making $15 per unit, but then as part of the sale, they gave free shipping, which was $18 a unit. So even though they were making a fortune in revenue, their cash was just going down and down and down for every sale. So they weren't actually making any money, which is more common than you think when you don't do proper financial analysis. So the first portion of the financial analysis is to look at your revenue. So here we have just our top line profit and loss. We have a sample for Turtle Co. that I just sort of made up these numbers. But our sales is $400,000. And so that's the first number we want to look at, and that's the number that everybody really likes to pay attention to. But when you're looking at your revenue, what you want to look at is a few different factors. First, you want to look at the revenue over time. So I put this as 2024. So this is how much we made in a year. You also want to analyze it by month to make sure that you're trending upwards, or sometimes you'll have a cycle like in retail stores or online sales. A lot of times they'll have Christmas bumps. They'll have March or April bumps when people get their tax returns. They'll have little slumps during the summer, things like that. So it's important to analyze your sales when they trend up and when they trend down. You also want to look at each individual item that you're selling. So I made this sales number up by our 4 products that Turtle Co. is going to eventually be selling. 2 different stuffed animals. We'll have a small stuffed animal, a large stuffed animal, and then we'll have T-shirts and hats. And hopefully that's our kind of beginning.
Can we show them one of
inventory.
the stuffed animals?
We can, yeah. You have one up here, don't
Wow,
you?
somewhere over there, yeah.
Here we go. Straight off the Temu website, right? We're going to start getting some of these manufactured.
Wow, he's very plush.
There you
So
go.
there you go.
So something like that,
If
we'd probably sell for $20-ish, something like that, and we'd look at our based on our cost of goods.
Sorry, buddy, $20 is $20.
Nailed it. So what you want to do is you want to look at the sales of all the different products that you're doing. So this may be one example, the T-shirts, or the T-shirts that we do, the hats that we end up doing, or any other products, and you want to see what are your best and worst sellers. Kind of figuring out what's going good, is everything priced appropriately, is some stuff not selling, and trying to figure out why it's not selling. So
I really thought those tie-dye T-shirts were going to be a thing again.
tie-dye T-shirts are going to be a thing.
I thought they were.
Yeah.
I got a whole bunches of them now.
Yeah, I think you're maybe a few years early. The fashion trend will come back to tie-dye one day.
See, I just look at it as an investment now. Can we write it off that way?
No, no, don't write it off that way. So after you analyze your revenue, we want to analyze our expenses. And so again, I've done some samples of like a regular business. You have your office expenses, rent, insurance, payroll, all of that stuff. And you want to kind of figure out where you're spending money, where you have to spend money, where maybe you can cut expenses out and try to get more lean and efficient with your expenditures. So one of the key facts to look at is the fixed costs versus variable costs. At the top, we have our cost of goods sold, and those are considered our variable costs. So we have our cost of goods sold, we have our packages and labeling, and then supplies. These are expenses that are directly in proportion with our sales numbers. The more sales we have, the higher those go up, and vice versa. The ordinary expenses is what it's called. Below necessary and ordinary expenses are below the line under your gross profit. Those are considered somewhat fixed expenses. Now, sometimes those will still fluctuate with sales, but a lot of those are going to be fixed, like wages, rent, insurance. You just have fixed costs for a certain amount of things. And then we can get down to the bottom line number, which is net income. So we have our revenue at the top, minus cost of goods sold equals our gross profit, and then minus all of our ordinary expenses, we have a net income. And that's sort of the analysis of the profit and loss. So you want to go line item by line item, figure out what costs are making up each of those numbers, and analyze them.
So bottom line, looking at this chart, I brought in $400,000.
Mm-hmm.
I, after deducting all of my expenses and everything associated with that, I'm left with $26,000.
Correct. Well, 26, but then we also add depreciation in there on the equipment we bought. So that is the net income of the business, and that's the taxable income of the business.
That's the accountant version of, oh, I'm sorry you feel that way.
So that's our tax, also known as our taxable income, the net income. Another thing that you want to analyze when you're going through the profit and loss too is shrinkage, and that'll happen for a number of reasons, and it's one of the most common problems with small businesses when they mismanage their funds or they end up going broke, is shoplifting at stores, vendor theft, employee theft, wage theft can be a big one. There's a lot going on. Admin and accounting errors, and then just missing invoices. Not paying things on time. A lot of late fees. A lot of my clients have late penalties for not paying their taxes on time or not paying their mortgage or notes on time. It's a common thing, and it can really eat up your budget.
And it's also a nice source of revenue for a lot of these companies.
It is. There's a lot of companies who live and die on those. Credit card companies, they only make money on interest, really. So
Right.
They want you to spend all the money. The next thing that we're going to analyze a little more closely is the balance sheet. Now, a lot of people forget to look at the balance sheet. They really concentrate, like you talked about, on revenue. Some of them, their next step is they pay attention to what's on the expense side of things, but very few people really take the time to analyze the balance sheet. Now, a profit and loss or a net income statement is a picture over a time period. So we have it over a year period or over a month or over a quarter. A balance sheet is really a snapshot in time. So it's just a picture of your company on any given day. So this one we do December 31st, 2024, and this is what it looks like. The top portion is the assets. We have cash assets of $45,000. We have accounts receivable of $7,500. Accounts receivable is what people owe us money. And then we have our fixed assets. So in this example, we have $105,000 worth of equipment that we purchased to make this company happen. And we also have $25,000 in building improvements. So when you rent a space, oftentimes you'll come in and do a bunch of work to make a building nicer or work for your benefit. Those are, that becomes an asset that is then depreciated. So important to look at those, and you can see that you have the accumulated depreciation. We have a depreciation expense every year, and that gives us our fixed asset total. So we have a total assets of $163,000 in this company. And then down below is our liabilities, which is right now we just have payroll liabilities. And then you can see there I show that we took a note payable of $20,000 out. And we also had a shareholder contribution of $75,000. So to start this company, technically we spent $155,000. And that's how that works. So you want to analyze this alongside the profit and loss so that you kind of have a snapshot in time of your company.
This is all very, very important stuff, people.
It is. Cash flow. Now, this is the one that people never think about, but the statement of cash flow is almost as important as the profit and loss. Net income, like we talk about sometimes, does not always equal how much money you're making, because you have to think about your debt service and you have to think about assets that you're purchasing and those kind of things. So this has three categories. Net income is adjusted for operating activities, and then you have your net cash provided by operating activities. Then we have our investing activities. We see we spent some money on building and equipment. And then below
asking for a friend, under which of those would dinner at the strip club go?
None of them, man. None of them. It's not deductible. Yeah. Can't deduct entertainment expenses.
Even when they stand on business?
Yep. Even when they stand on business. So anyway, this shows our cash at the end of period. And this is important to go through so you have a good idea of whether your cash is increasing or decreasing. And then the last portion of financial analysis is the equations, but we'll actually go to this first. I apologize. This we started in our financial analysis portion. It's good to come back to this to adjust your monthly pro forma. So if you click on that monthly pro forma, this is one that I made up for when we were talking about originally planning this Turtle Co out, and it's used on our website to show you the financial analysis. Financial budgeting, when you do your analysis, you should go back and see how close you got to each one and where you're off a little bit. So we'll have that up along with everything. But the last portion we want to talk about is just some common equations. So the first one is the gross profit margin, which is your revenue minus cost of goods sold divided by revenue, and that comes out to a percentage. And so your gross profit is basically how much profit you made when you just take into account your revenue and your cost of goods. And this should be a very good positive number, usually, depending on the industry, anywhere from about 30 to 70%, maybe even higher. For example, my service company, where I don't have very much cost of goods, is nearly 100%. The next equation that we're going to look at is the net profit margin. This is revenue minus all of your costs. And this can range anywhere from 10% up to about 20, 25%. You really want to look into this to plan accordingly for how well your company is doing. The higher the percentage, the more profit you're making. And we'll have more information about all of this.
I very much doubt that most entrepreneurs can come and give you on demand any of those numbers.
Well, it's important to know. And
I agree.
You should be able to.
No, I fully agree with that, right? And there's, earlier you were speaking about bleeding cash with every sale.
Yeah.
A lot of people bleed on different levels when they don't know these numbers. And it's like, the old alleged Eskimo tale, where they just stick a knife blade up through the ice and let the polar bear lick himself to death.
Yeah.
And if you don't know these numbers, then you don't know where you're actually bleeding, and it's just a somewhere thing and a general form of despair. But when you do know the numbers, then you start to be able to take control of them.
Great points. The next one is the return on investment. Now, this one is somewhat nebulous, but your net return over your investment. So what that would be is the net income or the cash that we're getting returned over how much money that we put into it. So in our example, we have we've put in $50,000 of our own cash, plus we took out a loan for around $80,000. So we would take the $26,000 that we made and divide it by that total investment. That would give us our return on investment. More commonly, those are used for real estate or manufacturing and equipment companies, things like that. But it's another good one to have. One after that is the debt ratio. This is one commonly used by banks. They'll take your total debt and divide it by your total assets. The lower that number, the better your debt ratio is, and the more willing that people are usually to lend you more money. And then the last thing to talk about is what's called an EBITDA. So this is very common. It's probably the most widely used measure of profitability in any companies, but it's called earnings before interest, taxes, depreciation, and amortization. So it's basically supposed to be the net cash flow from operating activities in the current year. And we use EBITDA to value companies all the time. That's the most commonly used form to value a company's total worth. So we take that EBITDA and we usually add in a factor somewhere between 2 and 7 times, depending on the industry, and that's how you come up with a good valuation of a business.
It makes perfect sense to me.
Okay. Well, that was kind of the quick and dirty financial analysis. We're going to have quite a bit of information up on the website and a lot more in-depth and talk about each of the equations and how you can kind of go about analyzing all of your revenue and expenses. But
so for me, right, just from an emotional standpoint, it just kind of feels better to know where your money's at, because then you can make different decisions about when to make moves in your company. Should I or shouldn't I buy that $25,000 printer?
Right.
And yeah, you might be able to have a credit card or a couple that you can put it on. But the interest on those cards might end up killing any value you got out of the printer.
Yeah, 100%. Yeah.
So, when you know the numbers, when you really do know them, right, or you sit down with someone who knows them and then you can talk about it, then it really does make a big difference in how you start to think about how you go about your business.
Right. And the end goal of this step is not to become an expert in financial analysis. Like, it takes years to really learn how to do everything. But having the basic knowledge so that you can have an intelligent conversation with your accountant or with a consultant or with somebody who's helping you on the finances is really the key takeaway here. You want to be able to have intelligent conversations about your business and the financial health of it.
Or, we had a conversation one time about whether we should switch to like a membership model.
Mm-hmm.
And you broke it down in terms of, well, let's, how much do you get now from the activity, right? Mm-hmm. And we said, okay, so if we take that, times X amount of people, then that's the minimum number of members that you need. And then you've replaced the income that you now currently get from just letting anybody come in.
Right.
And when I thought about it in that way, it made so much better sense. Mm-hmm. Then, I don't want to talk to everybody.
Yeah.
But excuse me. But that's what I mean, right? Is it lets you start to focus on, okay, well, I hadn't thought about it in that way. I'm just actually replacing this amount of income, for this guaranteed amount of income that mm-hmm. basically balances. And then if I do a little bit better over here, then I at least have this guaranteed and I know I can improve.
Right. Yeah. Understanding this financial analysis type of stuff will help you make those decisions.
Right.
So when you came to me with that idea, we just did the math and figured it out, whether it was a good idea or bad. So, and it is not a bad idea if you decide to move in that direction, but you kind of have to change your business model when you make big decisions like that. Yeah. This podcast is brought to you by S&H Business Services. We are serving the OKC and greater Oklahoma area. We offer tax preparation, accounting, bookkeeping, and payroll services for small businesses and individuals. You can find us at shbusinessservices.com. Again, that's S&H Business Services, found at shbusinessservices.com. Well, I guess we're on to our second segment. We're going to be talking about the gig economy and how it affects individuals and small businesses. And you've got some thoughts on this to share, yeah?
I do, and I let many of them go in our last bit of conversation there, where we're not recording for the. I thought we were already recording our second segment at that point.
No, we were learning, trying to figure out what we were going to talk about.
Oh, okay. So we were educating ourselves on the gig economy.
Well, I needed to know what angle we were going to go at here. So you got an angle for me, I think.
My angle is this, right, is that we're on the side of small businesses, right? We want, if you're going to build a restaurant, if you're going to build a plumbing supply or a 24-hour plumber, any sort of business like that where you're going to rely on people finding you in times of need.
Mm-hmm.
They're hungry, they're wet, right? They're too cold, they're too hot, whatever it is. They need a service. You provide it. You're a small business, you're a restaurateur, you're a luggage repair guy, whatever it is. Then along comes a giant-ass company, and they say, we are going to give incentives for all these people to join our app, right? So they're only going to use us. Basically, we're going to be the only window into what food is available, right? Or
yeah,
what
like
services are
DoorDash and
available.
Uber Eats, Postmates. Those
Exactly,
yeah.
right? And you will be either visible, hyper visible, or invisible, depending on how we decide to rank you or where we decide to classify you.
Yeah.
Unless, of course, you subscribe to or pay for this tier or this tier or this tier, or you agree to, whenever a service is ordered through the app, which we enticed customers to do because we gave them a lot of free incentives like free delivery or 10% off or whatever. We just did all that because we knew that we would get it from you anyway.
Mm-hmm.
And in this manner now, we can make you invisible, somewhat visible, hyper visible, wherever we want to put you. That's where you are.
So you're saying that the big companies make the small businesses pay to be listed in a certain order?
Sure.
Yeah.
Sure. In one way or another. And so what I'm saying is that the gig economy relies on not only the production of whatever it is that you need at the time, food, you need food delivered to you, whatever, right? We already have, what it has shown is that there are a number of people willing to spend their time looking at the same app. You put it in an order, and then 20, 50, 100, depending on time of day in the market, people might be looking at that and going, I will take that order and fill it.
Oh, for delivery?
Yeah, I will either go to the restaurant where it was ordered and pick it up and promise to deliver it. I will go to the grocery store and grab the bag of groceries, promise to deliver those without bruising the bananas. So that same company that made the app, right, has positioned themselves to be absolutely between not only the producer of the product, right, but the deliverer of services, right, or the shipper of services, however you want to put it, courier, and the consumer. So they take a bite out of each side of it and they make in the whole transaction, right, from production to sale, they have not only inflated the prices, but they take the bulk of those prices, right?
Mm-hmm.
And the only reason that this can happen is because small businesses, the ones we advocate for, are forced more or less because of visibility to accept terms that they wouldn't otherwise accept, just to at least be on some sort of equal footing or equal visibility by the mass amount of consumers that more or less became addicted to the ability to easily order food delivered from anywhere.
Well, I like DoorDash. I order probably too much, but I don't overspend or go into debt on DoorDash. But I know a lot of people spend way too much money, more than they can afford on there. And I guess sometimes they're forced to. Calvin was telling us a story about how some people living in food deserts, they are almost reliant on some of those apps. Is that right, man?
Yeah, I mean, there's probably, at least a few cases that I can point directly to is like people that I personally know here in Oklahoma City. But I mean, even if you just look at it logically, you do have areas that, the government has deemed the term as a food desert. I believe the technical or the definition being that you don't have a grocery store or a place that serves fresh produce within a certain amount or a certain mile radius of you.
Yeah, probably within walking distance, huh?
Yeah, I think it's, within walking distance, I want to say like 1 to 2 miles or something like that. But these people have now, these days, become more reliant on the gig economy, such as, food delivery services, grocery delivery services, and things like that. To the point that it's, if you calculate what they're paying over the amount that they normally would pay if they just walked into some of these places, then yeah, I mean, it's a pretty significant amount that's squeezing the customer. Like you highlighted before already, John, they're squeezing the companies and, the drivers themselves that are making the delivery to that person. So each one of those phases, the producer, the transportation, and the recipient are all being hit by the same company 3 different times on the same transaction.
Yeah, and the company's making out like a bandit.
Oh well, and not to mention even the government, to the extent that any of those people involved in all those, ways of slicing up that transaction themselves are subject to taxes and so on.
Yeah, now I don't have much experience with restaurants working with these apps, but I do have quite a bit of experience with the drivers, and rarely do they end up paying taxes just because of the mileage deduction, but a lot of them do not make that much money off of it. I think Chandler did a statistic here that an article shows that if you make $62,000 driving from Uber, and that's the revenue, that really your take home after all the fees and stuff are subtracted is $27,600. So less than 50% gross profit margin.
Oh yeah, but then you have to deduct the 9% Connecticut tax, and they're left with a net of $21,000 on $62,000 in earnings.
Yeah, which is brutal. Self-employed people who receive a 1099 MISC from companies, or really now it's called the 1099 NEC, which is non-employee compensation. They are subject to both income and self-employment tax, which self-employment tax is just 15.3% right off the top. And then you're also subject to regular state and federal income tax.
So you're not an employee, you're a contractor, but they're going to hit you with 15.5% right off the top of whatever it is that Uber says they paid you.
Well, not after what Uber paid you minus your expenses. And so as a driver, you can always deduct any supplies that you have, and you can deduct either actual costs of fuel and repairs, or you can take the mileage, which mileage is almost always better. I think it's 65 cents a mile now. It's going to go up in 24 for 24's taxes.
Right. So after all your deductions and everything, then whatever you're left with, they're going to get 15% of that, 15.5% right off the top.
Plus your regular income tax. So really it turns out to be 35 to 40% for most people.
Yeah, so 35 of every dollar you're left over with after all that deduction.
Yeah, 60
They're
cents.
going to get 60 cents of that dollar.
But you're left over
You're
with 60.
left with 60
You got to pay
cents.
40% in federal, and then you got to pay your state, which Connecticut's real high. California's awful. New York's awful. A lot of these big states. If you live in Texas or some of the states that don't have income tax, you're in business.
So my basic position here is this. Is if I give a discount to someone, I can't then turn around and claim that discount as like lost revenue.
Well, no.
You know, I can't just say it's, well, I would have gotten that revenue, you know, but then I gave a discount. Can't have that.
Right.
But these companies, they make a sale. They take, you know, 20% of your sale. Am I able to claim that 20% that they took?
All the fees and stuff that they take, you get to knock off. So that's why a lot of times you'll see on DoorDash they charge, or Uber Eats, I think too, they charge more on the app for the food than they do at the restaurant, just to make up that fee that the company takes. But yes, you're allowed to deduct that.
Well, that's at least good.
Yeah.
You know, because I was gonna say if they're gonna you know, reach their fingers in and take money from the small business owner.
Yeah.
And the small business owner then has, you know, less revenue.
Yeah.
So on.
All those fees and hidden expenses you can deduct, but it's still a squeeze on companies. It's better that they get the money and pay taxes on it.
Right. And then they hand out like discounts and incentives to consumers. And they take that money frequently from the drivers and from the fulfillers of the orders.
Yeah, drivers can sometimes get pretty hosed on the whole deal. But I've seen some guys make quite a bit of money when they really work long shifts and hard hours, and they kind of figure out how to game the system to get the right amount of tips and stuff like that.
Game
They
that
can do all
system
right.
with those long shifts and hard hours.
Yeah. And figuring out which trips to take. There's a lot of information out there about, like, you know, you should take only trips that are paid a certain amount per mile, stuff like that.
Isn't that crazy how people are just so secretive these days that they put all their secrets on YouTube?
I guess it's all pretty. I don't think anybody's really got secrets. They just kind of figure out how to game it and share the information.
They're
Usually.
like, how I became a millionaire driving Uber. Follow me.
This is an interesting statistic too that Chandler found. It is projected that in 2027, 86.5 million people will be freelancing in the U.S., and that makes up over half of the U.S. workforce. That is wild. That half the U.S.
So
workforce
half
would
of
be
us are going to be
freelancers.
jumping monkeys for the other half.
Yeah, something like that, man. Freelancing is a tough gig. I mean, starting your own company is technically freelancing. You know, then you kind of build a company with employees and stuff. But most small companies start off as, especially service ones, are just kind of freelancers. Like, that's how I started off, just doing, you know, piecemeal work for clients, and then I built into my business. But that's going to be wild if half of the U.S. workforce is no longer employees. They're all getting 1099. That's a lot of self-employment tax that people are going to be paying, and they're not going to be happy about it.
Or not paying.
Well, or not paying.
It's going to be there's going to have to be a lot more tax enforcement.
Well, we'll see. I don't know. They're talking about lowering it, so it might even be easier to get away with stuff in the future. We shall see. Well, any final thoughts for this week's episode?
No, I don't.
All right, man. Well, we'll see you next time.
All right.